So I'm going to start again here. Good evening, everyone. Thank you for your attendance. I really appreciate it. I am Sensei Kevlar, and I'm here to speak to you about the way of the profitable trader. I'm going to start out this evening following up on some information that I was talking about yesterday. Of course, I'd always like to start the same way, though, and that's with a review of the way of the profitable trader. So let's just bring that over here on the screen. The idea is that when we want to be profitable, we need to plan to be profitable. The mantra is simple. If we plan to be profitable, then we will be profitable. And if we can prove that that plan is profitable, that is the plan that we should be using for profitability. Therefore, we should plan that trade and trade that plan. The idea is we're going to do a study to create indicators, make a case for our position, build support for that position, back test and forward test it, and finally make that trade by putting all of our entries in at the same time, because we know ahead of time that this is going to be a profitable way to trade. So I'd like to take a moment to acknowledge that the Bitcoin market is, as usual, funny as ever. If you bring the chart on over, we'll just start by taking a look at the chart, because it's quite amusing in my opinion to see what's going on. Let me just bring it right up to the last couple of minutes here, because yesterday I was talking about some of the reasons why technical analysis doesn't work. One of those reasons is whales, because whales will do whatever they want. Here's an example. Today, during the afternoon session, we go to I don't know, the 3-hour chart. We can really see it pretty good. Or 3-minute chart, we can really see it pretty good. Here's a whale just dumping, and then somebody bought right back. I'm not exactly clear on what happened here, but if somebody were to put their stop losses right here, you would have exited, and boy, that would have really been a nasty trick, right? So the market can do those nasty things to you. You need to be able to play those games with the whales. And so that's why I recommend really looking for those resistance lines, because clearly at some point we found resistance here at 233, which is why I recommend always putting your stop losses well below the existing resistance lines, so they can kind of the market kind of slosh around here, and that's not going to put you out on a false signal. This is what I call a fake out, because it looks like the market's going down, and then no, we've decided to just continue on like nothing happened here. Really tight candles, as if nothing had gone on here, right? So don't let these types of things trick you. You need to have a strategy, and you need to backtest that strategy. You need to prove that that strategy will deal with situations like this more often than they will get you with situations like this. That's part of the strategy, and that's part of the profitable way of the trader. So I really want to stress that, is when you're doing your backtesting, you have to account for stuff like this. This absolutely happens, right? Now, if you look, fortunately, if you were doing the math correctly on this one, those levels were not anywhere near where our stop loss levels should be, according to our support and resistance line. So let's just bring those in really fast to go ahead and do a quick study of that before I move on to more information that I had talked about yesterday. So I'm just going to put my support line right there at 228. Historically, I think that's a fairly well supported line right there. And then, there's a resistance line that's happening right here at 230. So let's go take a look at what happened over here. If we were playing by the rules, we'd be down, somewhere right in here with our stop losses if we had gone into a long position. So we would have been okay, and we would have tested okay. So I'm gonna do more of those types of testing a little bit later in the session. But I want to point out that a profitable strategy will allow for situations like this. And what's more is you won't panic and just go ahead and exit the situation because you saw the market make a major move against you. The reason for that is the whole point of this is until you hit your stop losses, you're still confident about this. There's no need to say, oh, the market's moving against me, I'm going to go ahead and exit before I hit my stop loss. That's not how the strategy works. The strategy works by staying in the game and allowing for these types of situations to happen and backtesting those, making sure that those are profitable. So when those types of situations actually do occur, you have steady fingers. You are steady in your trading, in your security. Why? How do you know you're going to be steady? Because you've done it on paper a million times before, and this is no different. Just because it's with real money, you didn't need to erase your prediction when you were doing it on paper. So you've done this, 100, 1,000, a million times, as many times as it takes for you to overcome your fear and trade a profitable plan. And that's what I really want to stress to you, is that fear doesn't serve you in this market. That fear only serves to cause you to not trade a profitable plan when the plan should have been proven profitable to begin with. Otherwise, you wouldn't be trading it. So that's my piece of wisdom for the evening. Yesterday I was talking about arbitrage, and I wanted to go into that a little bit more. People had asked me, how does this arbitrage stuff work? So I want to pull up a document here, and I want to kind of go a little bit deeper into the arbitrage and the idea behind arbitrage and how this can be profitable. As I said before, the idea here is that there's a difference in prices in the exchanges, and we're trying to take advantage of those price differences, right? So I'm just gonna set us up with a theoretical example here. Here we're gonna presume that this is exchange A and exchange B, and there's a price difference on exchange A than there is on exchange B. Okay, and we're savvy traders. We know that these types of situations occur. And so we've already put our money into the market, and we've allowed it to be here. And here we are on exchange A, and we own 5 Bitcoins on exchange A, and we've also got $500 on exchange A. And on exchange B, we also happen to have 5 Bitcoins, and we've got $500 on exchange B. And we notice that there's an opportunity here. If we were to buy a Bitcoin on exchange A and sell that Bitcoin on exchange B, we could make $10 there on that trade, right away, just snap, just like that. Okay. The problem is that in order to buy on exchange A, you then have to do the withdrawal and send it over to exchange B. And, that takes time, and the price can have moved against you, and it often does, right? So that's a problem. So the savvy trader will do something a little bit more clever. He will go ahead and have his money ready in the market and buy that Bitcoin at 240 using his $500 here, and sell that Bitcoin at 250 using his money here. So let's see what happens when we do that. I've got my portfolio totals here, right? These are automated, so if I say that I have 10 Bitcoin here, this automatically changes, and this will automatically change as well. We'll go back to 5 though. Okay, so if I'm going to sell 1 Bitcoin here, that's going to take me down to 4 Bitcoin, and I'm going to add, 500 plus 240 is $740 to my portfolio. Okay. Other way around, sorry. I want to buy low, and I'm going to subtract 240. So 500 minus 240 is $260. Okay, now on this exchange, I am going to sell high, and I'm going to add $250 to my portfolio here. Okay. Now, what happened was I entered 2 trades at exactly the same time on each exchange. I submitted one trade to exchange A, and I submitted another trade to exchange B. What happened is that, you know, my position ultimately changed accordingly on the exchanges. But if you look at my portfolio position has not changed except for the addition of $10, and that $10 came from the difference in the price from when I bought low and sold high. Okay, now presumably later on down the line, 2 weeks, 3 weeks, a month, 3 months later, this situation has changed. Okay, now for whatever reason we're seeing 230 here and we're seeing 220 here. So what this does is this presents us an opportunity in the other direction. Okay, if we do the same trick here, if we buy one Bitcoin at 220, that'll take us up to 5, and we do 750 minus our buy price, which is 220, leaves us with 530. At the same time, we do the same thing here, bringing us down to 5 Bitcoins, except we are now adding the amount. Sorry, I need to buy. I still need to that was wrong. I was at, yeah, I need to count to 5, and then this should go to 510, because that is the difference, right? No, this should be 490, because I paid more. Again, the difference is $10, and my portfolio net has not changed, but I have increased it by another $10, the $10 coming from having bought low and sold high here, and this leaves us with an additional $10. So this is a long-term strategy, is what I'm trying to point out. The way it works is your money shifts around on the exchanges depending upon which direction the price of Bitcoin goes. And ultimately, the trades result in you holding more net over time, right? You have to add it all up and see what you're holding over time, okay? It doesn't work in a short term. It doesn't work when you're trying to withdraw it and move it around. You're going to pay way too much in exchange fees, and that's never going to work out for you in the long run. So that's how that works. There are bots that will do this for you. They will enter in both at the same time, and that's a very sophisticated way of dealing with the market. What I was talking about yesterday was using this as a signal, okay? Using this idea, and what that looks like is when you bring in the 1 week chart, for instance, and you make it a line, but you can't look at it that way. Hold on just 1 second. Always adjust your scale. Okay, that's scale, right? Okay. So you can use this you can attempt to use this, I should say, as an indicator, as a signal about what direction the market is thinking of going, right? In the past, when futures have been arbitrageable above the price of Bitcoin, we have gone down. But it's not always true, but it certainly has been true a lot of the time in the past, right? Here they were above, they go down. Then they were below, futures were arbitrageable below the price in the market, and we go up, okay? And up and up and up. Here they were above and we went down. So you need to test this. You need to ensure that this is going to be profitable long term, because then if you look, here's some places where they're above and the market is going up. And so that's different than what we've normally seen. We're looking for when they're above, it's going down. And eventually it does go down, and they seem to be right long term, but they certainly don't seem to signal any sort of meaningful direction short term. Because if you take a look, they definitely can be wrong about these things. And at this point, it looks like they have shifted again. So this idea that we can use arbitrage as a signal is actually really relevant. Another way of thinking about analyzing these types of patterns is if you bring it out to the 5-minute chart or the 15-minute chart, you can really start to see some obvious jumps here, right? And there's another type of analysis that you can do, coupled with some other as the indicator, and that's cycle analysis. And the idea behind cycle analysis is that the market really is in cycles, and those cycles are time dependent. They are visible on different time frames there. If you look at things from the 15-hour perspective, you're going to see a very different set of cycles than if you look at things from the 1-hour perspective. But ultimately, these cycles are kind of prevalent, right? So if you look, I've gone ahead and I've drawn a couple of cycle lines right here, right? Where you can see dealing with the market ups and downs. The idea is whenever the market indicates by entering a new support or resistance level, we consider that a cycle, right? And if it moves, up, we consider that a higher cycle, and if it moves down, we consider that a lower cycle. And so you can do sometimes, and this is certainly, not always, but sometimes you can do cycle analysis on these things where the market will get into sort of a harmonic vibration, if you will, where if you count the number of up cycles and then you count the number of down cycles, it will do things like, have a predictable number of up cycles, and then a predictable number of down cycles, and then a predictable number of up cycles, and then a predictable number of down cycles. And it's quite fascinating to watch when you actually see the market get into an oscillation like that. And so this idea of this oscillation, there's lots of patterns for dealing with harmonic oscillations, like the Gartley and the butterfly and stuff like that. I'm not necessarily going to show those to you here, but what I do want to point out is that the market definitely tends to have its own set of cycles, and what's more is analyzing those cycles becomes a lot more prevalent on much larger charts. In fact, any good TA is going to consider all time frames, as many time frames as you can possibly do the study on, right? If you see something and it's correlated across multiple time frames, that's definitely a stronger signal. So let's take a look at what I'm talking about here, right? Here we've got some serious cycles built into the market, right? This is pretty obvious right here. Every single time we go up and then down, we can just call that a cycle, right? Up and then down, up and then down, up and then down. And these things are on really regular patterns, right? They are literally, 1 and 2 weeks apart for the most part. And you can see these, right? So if you just, I'm going to do some a little further back here and do some on the left-hand side. Oh, that's not the one I wanted. That one. So I'm just looking for the market to go up and then down again. And every time it comes down and hits a new support line, I'm just calling that a cycle. So we'll just make that a cycle, make that a cycle. That's a cycle. Okay, let's take a look here. We've definitely got some cycles, right? This one we had, I don't know. You could definitely put this one. There's a red candle right in here. Okay, so we had 1, 2, 3 cycles up, and then 1, 2. Yeah, I think that's it's. You could probably fit that in there, right? 1, 2, 3 cycles down. Then you had 2 cycles up and 2 cycles down. This is just a really tiny one, right? Or I'm sorry, if you not okay. Then this up and down, right? This is 1 cycle up, 1 cycle down, right? These, I'm sorry, excuse me, not 1 cycle up, 1 cycle down. These 2 cycles are exactly the same, right? This is 1 cycle right here, right? So we had a bunch of up cycles, a down cycle, 3 up cycles, 1 up, 1 down, then just, two across. That's what I'm trying to say. Then we had 3 up in a row. Okay, so this is what I'm trying to point out. 3 up in a row, 3 up in a row. Okay, 3 up in a row, and then we had a bunch down. Here we've got 3 up in a row, right? Does that mean that we're now going to go down? No, of course it doesn't. But if we can look back and we can find cycles in the market that would support this type of behavior, this would definitely be telling. And, what we can do is we can look at different time frames on this, right? We can say, look at the current trends, right? If we look at the long-term trends, we had a lot of volatility right here, okay? This is a lot of volatility, a lot of market coming down, a lot of pressure coming down, okay? If you bring that in nice and tight, you look at these really large cycles that were happening, right? These cycles, these up and down cycles, these things were, literally a month long, And what's been happening here is we've been increasingly tightening our cycles over and over and over again. These cycles have been getting shorter and shorter and shorter, and we're really arriving at this 1 week heartbeat, right, for the market. And that's relevant. The 1 week heartbeat is definitely relevant. So if you put things on the 1 week chart, this is where things get interesting, right? Just now, things have been really volatile up until now. And recently, if you look at the week-long trends, the volatility has really come out of the market. We used to have a lot more volatility, even very recently. There's been a lot of squeezing that's happening here, right? So if you're looking at these trends longer term, and you're trading these trends longer term, that works too. Okay, technical analysis can work on any time frame and is valid on any time frame. And what's more is, is really only technically valid for that time frame. If you're looking if you're looking, here at the week-long chart, and then you can't see the rest of this, you'd tell me that it was going up from here, right? So obviously that's not a valid approach to it, but if you're looking at this right here, if you're looking at this pattern right here, I bet you could find this pattern right here. This is the beginning of what we call a flag. So when we have a red and a green and a red and a green and a red and a green and a red and a green, it forms a flag pattern. I bet you could find this here, right? I bet you could find the idea of we've got a big drop followed by a flag. And I bet you would find that when you had a big drop on a big time frame and it was followed by a flag, I'd bet you probably find that we had a gain after that big drop followed by a flag. And I bet you could find that over, there's one right there, and over, there's one right there, and over, there's one right there, right? I mean, you just have to put it on the right time frames. So then you have to look at these at different time frames, right? And different time frames will expose the different patterns. And by doing the different analysis on the different time frames, not only is this valid as a analysis, but it's also valid as a trading technique. If you only want to trade the long-term trends, you should only be looking at the day-long charts for the most part, right? That's the only reason that it makes that's the only way that the long-term trends expose themselves in any meaningful way, right? Here's a long-term trend right here. Is the reversal. Okay, so that's what we call a reversal, is when it's been going down in a trend for long enough. And then look at this right here. It found support for the first time, and it found more support there, and then it found more support there, and then it found more support there. This is on the 1-day chart. Over and over and over again, it has found support here. So if it comes down to here, and it does a third knock on the door, and then starts to go back up, that's a pretty strong indicator that there's at least some sort of long position available right there, right? And that's what I really want you to see. That's what I really want you to look for, is look for those different indicators that will show you what the market has done in the past. And, you know, look at what we've got going on right here on the long-term trends. I think it's pretty obvious that we could expect a return into this area and then, you know, more, okay? And we can definitely see some very specific drives that are happening here. So let's see if we can find the drives that are happening here, right? Here's the first major drive right here, right? Followed by the second major drive right here, and then the third major one. And then we had to let off some steam, right? Sure enough. Okay. Now, what we're seeing here is we're seeing that the amounts are very much correlated. In fact, they fall pretty close to the golden means of each other, right? Specifically, this is at 174% of the original 100%. If this is 100%, this would be 174%. Okay, and then from here, from this position right here, this, if this was 100%, this would be 131% right here that we gained. Okay, so go back and look for this pattern right here, the 3 drives pattern, followed by a loss. Okay, and if you see 3 drives, maybe that's an opportunity for a short position, because at the top of it, there's this loss. Okay, this works in reverse too. Let's see if we can find the 3 drives. Let me delete that. Let's see if we can find the 3 drives here. Probably not on this time frame for this, but if we go out to a shorter time frame, I bet it's possible to see it. I still didn't want to do that. Yeah, see, look at what happened here. When I went into the shorter time frame, it became obvious that our points were not quite right, but the patterns are still valid, right? We definitely had, 3 drives there, and this one was a big one, and this one was a bigger one. This one was a significant one. And what we're showing here is, while this one was a significant one, this one was 186% of the original gain. So this is almost 200% gain from here to here, right? What we're showing here is that we've lost steam. On this third drive right here, it just didn't have it. We only went up 130%. This is 100%. We only went up 30% more. Okay, so that's showing us that this drive mechanism that's pushing the market up has run out of steam. Okay, so that's why you can expect a sell-off at this point. And if you look at the 7-hour chart, it's really obvious that that's exactly what happened, right? But what I'm encouraging you to do is not go and find this pattern in the market and then trade it. What I'm encouraging you to do is go and find this pattern in the market and back test it. Test it over and over and over again. See if it's relevant. See if it exists. See if it leads you to any conclusions about where you are, where you might be today, and then try and build a strategy based upon that idea. So let's take a look at and see if we can't find that reverse drive. Yeah, there it is right there. It's pretty easy to spot. Yeah, we kind of did a little pause right here, right? Let's do it this way. Kind of did a little pause right here. That was a big one. Oh, that's not what I wanted to do. There's that little wick right there, all the way back up to there, only to fall back to here, only to a couple hours come back to here, only to within a couple more 7 hours, a couple within a day, lose all of that, and then it popped back up like that. Okay, so there's your three drives. It went down, we shot back up from right here, and if you look, I know that wick is hard to see, but it's there. And if you go to a different time frame, it's much easier to spot. Okay, there's the wick we're looking for, and there's the wick we're looking for right there. Finally, there's the wick we're looking for right there. Okay, bring that right up to there. Yeah. Okay, so what we're seeing here, we had a significant push down, right? This was 165% from here to here. But then, given this 165%, loss, this was 252% of that. That's ridiculous, right? So when we have three drives in the market in the past coming down, we had a nice spike back upwards, right? There it is right there. Now go and find this in the past and make this part of the strategy, right? So when you're looking for that long signal, go and find other signals, go and find other patterns that help you identify what it is that the market has done in the past, okay? And then make that part of your strategy. Do it on so many time frames that it hurts. Do it until you've got the hours memorized and the prices memorized for the hours, right? Sit there and make all of these strategies, okay? And then once you've done all of your drawing, here's the really boring part, right? Is you come in here and you say, on this date, at this time, I went long at 234 and I had a exit of 239 and a stop of 227, okay? And then now we got to go look at that date, and we put in our trade. We put in our trade on paper, and we put it in and test this. And then when the chart moves forward, we see, did that work, okay? And we do this like a robot. We sit here and we build these strategies and we test them and then we trade them like a robot. So the idea is to remove all of the thinking from the actual act of trading itself. So when you go to do the trade, all you are doing is pushing the button because you know that you're going to be profitable. That does not, however, mean that you start thinking like a robot. You have to be aware of everything that is going on in the market at all times. News, whales, whatever. That does not mean that you can just sit here and, put the orders in and write, bots that'll just do it for you. What it means is that you have to be diligent and apply your intelligence, apply your logic, apply your skill, apply your forethought, apply all of the back testing and all of the strategizing in order to build a profitable strategy. That takes intelligence. That can't be done by a robot. That takes, well, at least not right now, at least not the robots that I've met. And if you know one, please do let me know. But that takes, a certain finesse. That takes the skill of a human and the understanding of a human to be able to go out there and see that the news is anti-correlated to what the signals are saying, and that makes the signals inverted or invalid, or whatever it is that in the past when we have tested the situation and these types of signals have been in these types of positions, it has or has not worked. We have to account for these types of things when we're doing our back testing. We have to consider the conditions that the market is in at this moment when these signals are valid. And that has to be part of our strategy. So our strategy has to be constantly evolving. And it has to be something that we back test and forward test. And if there's something that isn't looking right about this, if there's something fishy about this, this is where money management comes into play. So I'm going to talk a little bit more about money management. We've talked about this idea that you can position yourself in such a way. Number one, you're not going to take risky trades. You're going to trade. You're going to using a portion of your portfolio. This allows you to do certain things. Number one, when a position is valid, but gets moved because of news in a certain direction, it allows you to double up on that position and turn what would otherwise be a losing trade into a profitable trade. Let me give you an example of what I'm talking about here, okay? Right now, let's say that you had decided last night that after this big drop, you were going to go long. I know some people who did. So we're going to address that type of situation right now, okay? And how one possible way of dealing with it. And I'm going to go back in the charts so that nobody's tempted to actually use this in a live situation, okay? Let's just say that, that after this big drop right here, you thought for sure it was going to go long, right? This thing had just happened. You'd seen 3 drives down, 3 symmetrical drives down, and you were sure this was a market bottom. Why? Because look at right here, right? Look at what happens. Over and over again, this has been symmetry. This has been resistance for us. There is no reason not to think we just found our new support right here. See the line right there? I'm going to bring that line in. Okay. Now, we're going to go long because we've seen 3 drives down before, and we know what happens after 3 drives down. Okay, we're going to go long, and the market is going to punish us. It's just going to hate on us, right? Absolutely hate on us, okay? At this point, we have 2 options. We are in a long losing position. Presumably, our stop loss is right here, okay? Now, I don't recommend this strategy because this is how you get chewed up in the market. But if you really do believe that this is the market bottom, and you have so many indicators telling you that this is the market bottom, that you absolutely need to go long at this point, no matter what else is happening. And it doesn't make any sense to go ahead and exit that other trade because you're already in a long position. What you can do is you can double up at this point. Okay? What this does is if you were long at this point, you're now long having doubled up here at halfway, but your halfway point, because $100 at 225 and $100 at 214 averages out to somewhere in the the 221 range, right? 221. Okay, so the idea is that in order to make this a neutral trade, all we have to do is a return to 221. We no longer have to make this into a nasty losing trade where we take our, knocks and go suck our thumb and cry about our losses, right? So the strategy here is to double up and then allow for the return back to here before exiting our position. This allows us to turn what we thought would be a profitable trade into a neutral trade. And that can be much better than a gigantic loss. So let's see if that would have worked for us in this position. Sure enough, we could have gotten our exit right here and turned this into a neutral trade, even with a little bit of bonus on top for a little bit of win, a dollar's worth of win on whatever our position was. This is why it's really, really important to trade using a portion of your portfolio, because otherwise you wouldn't be in a position to do this. You'd be hitting your margin losses. You'd be having bad things happen to your portfolio. But look at if it's 10% of your portfolio, you've only lost a couple percentage on that 10%. It's no longer a detrimental loss. It will no longer take you out, even if you decide I'm out, forget about it, I'm going to exit here, accept my stop loss, it's below my resistance line, I think it's going to go down more, even after 4 drives, even after breaking out of the harmonic cycle. I don't think it's going to go back into the harmonic cycle. I'm going to take my losses, okay? So this allows you to limit your exposure. This is really, really important because the profitable trader will do this over and over and over again. And there's no need to get greedy about getting your money into the market and into, a position. And so that's the final thing that I'm going to talk to you about is when you're doing positioning and when you're thinking about your positioning. And again, this falls into the category of money management because this is, how you manage your wins and your losses, okay? When you decide to follow a strategy, you have back tested it, you have forward tested it, you make that strategy work for you because that's what a profitable trader does. If that strategy doesn't work for you, don't keep trading it. Trade a different strategy, one that will make you profitable. But most importantly, when you are doing this, you have to make sure that there are opportunities for you to pause in the market because the market will do strange things to you and it will fool you and it will take your money away from you if you let it. So this is my final piece of wisdom with regards to money management. Right now, in your portfolio, you have X dollars and Y Bitcoins. Tomorrow, when the market does a gigantic move, one direction or another, you will still have X dollars and Y Bitcoins. Okay? The market can't touch you unless you choose to give your money to the market. It isn't until you enter a trade and give your money to the market either way that you win or lose money and become not profitable or not profitable. So I invite you to pause and take a moment to examine your position and figure out a strategy that will make you profitable before you continue, because this isn't a skill that you pick that you have to pay in order to learn. This is a skill that you can not pay. You can simply pick up the skill by doing paper trading, and it will cost you nothing at all because you won't make or lose money until you enter a trade. I hope to see you all on Reddit, on Slack, on Skype, on all the chat hangouts, on all the exchanges, and I hope you all have profitable trades and will join me here tomorrow for our final session. Thank you, and good night.